Hi everybody, Brian here from quantlabs.net. I just wanted to go over with recent news on as the markets tank, what's happening in places like China. China getting hit hard. The Shanghai Composite Index is now down negative 19% from January high. So this is from an article on June 25th from Zacks.com, China. Stocks running downhill, global week ahead. So the decline resumes. First time since a major rout in 2015. China's stocks erased 514 billion US in market value last week, or the equivalent of the Swedish economy, after Trump administration threatened additional tariffs worth 200 billion from following Beijing's retaliatory duties. Thing is, people don't realize that since 2005, there's been a trade war that's been underway because of China's pretty well ill will practices by not having fair trade between the U.S. and China. And as a result, Trump comes along and he threatens to do something about it. So here we are. So that's been underway for about well over 10 years. Where the U.S. has been running at a deficit. So again, number one driver down is the Chinese markets are on the defensive. Stocks have had their biggest weekly decline in 5 months. Cash rates are rising. 14-day repo rate hitting a 2-month high as firms locked in funding to cover the end of the quarter. So the bank reserve ratios are likely to be cut further. This is the Chinese People's Bank of China. Policy easing expectation partly driving the yuan slide. Investors wondering how far the weakness will go. Weak yuan will help offset trade impact, yet rapid currency fall, aside from provoking more iron, Washington could feed on itself by fueling further outflow of money from China, as happened after August 2015. I remember that. It should also be bad news for other emerging markets, Taiwan, Mexico, South Korea, that compete with China in export markets. South Korea, I don't think will get hit because they've got a lot of quotas agreed with the U.S. for steel and aluminum. But Mexico, for sure, will get hit hard. Another article, this is from June 19th, again about the U.S. trade war spat. This is from MarketWatch.com. Article name is Escalating U.S. Trade Spat Comes at a Bad Time for Global Growth, Economists Say. Breaking from a pace of 6.8% year over year in the first quarter to 6.2% by fourth quarter, Chinese was set too slow. Without trade dispute, and policymakers were already less likely to respond with a type of stimulus they have implemented in the past to benefit the domestic and global economy. Economic model suggests that the trade actions will shave 0.1 to 0.2 percent point off growth in 2018 and 2019 for both countries. That the impact has already been incorporated in the firm's forecasts. Just going through this right now. So, now remember the date on this article was the 19th, but just to give you an idea, if you have not been tracking this, U.S. stocks fell sharply Tuesday, that's last week, before trimming losses with Dow off more than 400 points at its low. Most recent action, S&P fell 0.4%, while the Dow shed 1.9 or 1.7%. Monday, the Dow Jones Industrial Average down negative 1.42%, fell fifth straight decline, while the S&P was down negative 1.53. Saw Asian exports take heavy hits and sent China stocks to its lowest close in 2 years. European stocks were also under pressure. So not pretty. Trade worries are paying more attention to strengthen domestic data and expectation. Corporate tax cuts signed into law last year and other sources of fiscal stimulus will provide the fuel will eventually allow the S&P 500 and Dow to challenge all-time highs in late January. GDP product grew 6.8% for China year over year in first quarter. And above target 6.5 for 2018 means growth will need to slow significantly to prompt substantial policy easing. Okay, and that's pretty well it. Hopefully this will help you out. We shall talk to you soon.